Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Max Horster. He's Managing Director and Head of ISS Ethics Climate Solutions, a unit of institutional shareholder services that enables investors to understand, measure, and act upon the implications of climate change on investments. Max developed the industry's leading methodology to gauge and assess climate impacts on investment portfolios, resulting in the world's largest database of company-level climate change data. He holds a PhD in history from the University of Cambridge. Welcome, Max.
Hi, Richard. Great pleasure to be here. Thank you.
Great. I just thought we'd start if you could provide a background, how you got into this field and your career.
Sure. So my background, you mentioned that my focus used to be on history. After that, I ventured into asset management, and I worked for almost 5 years with a large global asset manager, Capital Group companies, and it was there that I realized that a topic very close to my heart, climate change, started to matter for investors. And with that thought in mind, I started a small company in Zurich in Switzerland, and we operated under the name South Pole Group, where we were among the first to look into the topic of investments and climate change. That was 8 years ago. We were a little bit early, so at the time when we started, the only investors really interested in this topic were so-called mission-focused investors, i.e. church investors or foundations or so, who wanted to understand whether their money that they invest is aligned with their mission. But over the years, that changed dramatically, and since about 3 years or so, the topic has really arrived in mainstream investments. Mainstream investors come to the topic from an entirely different angle, which is from a risk perspective. So not so much is my money helping or harming, but in how far does climate change effects and legislation potentially impact my returns. And in the wake of this, the market grew tremendously, very fast, and we were a leader in this market, and we realized that organically we couldn't keep up with the market growth. And we were approached by quite a few organizations who were interested in acquiring us. And so at some point, beginning of last year, beginning of 2017, we decided to enter a process at which end there were a handful of companies that were interested in acquiring us. And we had we were in a great situation to be able to choose whom we want to partner with, and we decided to become part of ISS, Institutional Shareholder Services, which is probably known to the audience of this podcast as the largest provider of corporate governance research and services, proxy voting. But ISS is also one of the largest and certainly fastest growing provider of so-called ESG data, environmental, social, and governance data, so non-financial information. And is fastest growing in two ways, by its organic growth and it's by acquisition. And so we were one of these acquisitions, not the latest, I should say. 3 weeks ago, we added the German ESG research house Ökom to our family as well. But since June 2017, we are now part of ISS. We operate under the name ISS Ethics Climate Solutions. And as you said at the outset, we basically do three things. We help investors understand what climate change means for their investments and what their investments means for the climate. And secondly, we help measure, do that based on data, on the largest database out there, on company climate data. And thirdly, we help investors act upon that.
So this is a fascinating topic area, and wondering what your thoughts are on climate change. Do you see global warming, global cooling, combination of the both, and what industries, sectors of the economy will be affected by climate change going forth?
Mm-hmm. So I must admit that my view on climate change is impacted by the view of the scientific community on climate change. So I'm not a climate scientist myself. I obviously read a lot about it, and as you're probably aware, the community of climate scientists is in agreement that I think nobody is questioning that the climate is changing anymore, I should say. There is still a bit of a debate of what the role of human beings is in that, of mankind. 97% of climate scientists say that mankind plays a role to different extents, so it's a scientific debate that is happening. But climate change is taking place, and let's say at least the global community, policymakers and so on, follow the scientific view, which I believe is the right thing to do. That mankind is the reason for that. It is the reason for this is in emitting greenhouse gases that we emit through the way we operate our businesses, we produce our electricity, we consume and so on, and therefore, in order to limit the effects of climate change and reduce the effects of climate change and potentially combat climate change, we need to change as a world, as economies, as societies, and that is to the second part of the question. What sectors are impacted? I think it's first important to understand what the changes are that come with climate change. And typically we differentiate between, we approach it from a risk perspective, we differentiate between so-called transitional risk and physical risk. So physical risk is, I think, the easily understood. When climate changes, and by the way, it can be warming and cooling, by the way, so it depends on what geographies you are. On average, the global climate is warming. However, there are certain geographies where it is cooling because these are kind of, the ripple effects and that result in that. But in general, when the climate is changing, certain physical effects happen, short-term, extreme weather events, floods, drought, but also, heavy rainfalls, abrupt cooling and heating periods and so on. But also more long-term changes that impact the economy. And so these physical effects are obviously impacting or can impact theoretically all sectors. So if you are producing, fertilizer, let's say, for Southern Europe, and due to climate change, agriculture won't be possible any longer in the south of Europe, your company might not be really affected by climate change, but the market that you cater to is. Same could apply for your supply chain, right? So we saw with the last year with the floods in Southeast Asia that the supply chains of quite a few car manufacturers were impacted by that. So these are physical effects that can theoretically hit every industry. Then there are transitional risks. Transitional risks are the risks that come with the world closing in on climate change and trying to mitigate it. And that is, of course, being done by regulators stepping in and saying, we need to stop emitting CO2. This is triggered by societies changing the way they behave, the type of cars they drive, and so on. So this is what we call transitional risk, and there, especially heavily greenhouse gas emitting industries are impacted. So that would be, for example, the oil and gas industry, the utility sector, at least the fossil fuel-based part of the utility sector, the energy sector in general. Car manufacturers can be impacted. And in these industry sectors, you have to differentiate between industries where there is a substitute technology that is kind of climate adjustable and where there isn't. So if you think about car manufacturers, you can of course produce cars that are emitting less or no greenhouse gas emissions, or electric vehicles, substitute technologies for the combustion engine. You can also of course produce electricity through other means than burning coal or gas. You can run renewable energy power plants, for example, or geothermal, or whatever it is, water, wind, solar. So there are substitute technologies. That means a company that is in a specific sector, the sector is impacted, but the company can transition. But there are also sectors that cannot transition. An oil company is an oil company is an oil company, and if it doesn't produce oil any longer, it is, it falls into a different sector.
Yeah.
So this is kind of how we approach this, looking at different sectors and what effect climate change legislation on the one hand, and climate change effects, physical effects on the other hand, how they impact those sectors.
And does your firm ISS advise clients on climate change issues relating to ESG, CSR, corporate social responsibility?
Yes, this is the core of what my group and I are doing. So we advise and we provide data and screenings that help investors frame the topic of climate change, then measure where they stand vis-a-vis these risks that I mentioned, physical risks and transitional risks. So, we would look at a first step, let's say, framing the topic means we help an organization, sometimes very large asset managers or asset owners, to understand what the topic of climate change means for them, for their specific DNA. So to give you an example, if you are a government pension plan of a country that is heavily dependent on oil exploitation, you might take a very different view on the topic of climate change than a church investor, or you might take a very different view than an insurance company that not only has the asset management side but also the liability side and is therefore impacted by climate change. So framing the topic is the first step that we help investors with, and that is typically advisory work. So there we come in with our consultants and we help determine what climate change means. We help creating policies around it, setting targets and so on. Then in the second step, we help measure where the client stands, where the investor stands. And that is typically done by providing an investor with data. And that can be either that we provide raw data because the investor has the capacity to, based on our data, run themselves the analysis where the big risks in the portfolios are, where the opportunities are, where the impact lies. Or, and that is more often the case, especially when an investor starts looking into this topic, they send us their portfolios and we run the analysis on their behalf. So there we create, either very short or very extensive reports, depending on who the stakeholder is and what the aim is. We create reports that point out, almost like a heat map, where the risks and the opportunities in the portfolio are, and also suggest steps that investors can take to address those.
So in terms of the actual measurement tools and methodologies, what are those that ISS uses in assessing the investment implications of investment asset classes and firms?
It's a wide variety, but typically what investors start with is a so-called investment carbon footprint. The logic is that you own, let's say through an equity portfolio, you own 0.1% of General Electric. So with an investment carbon footprint, we would allocate 0.1% of GE's greenhouse gas emissions to your portfolio. To you first, and then you can do that for other companies in your portfolio as well, and by that you basically can calculate your emission exposure. You basically understand what is my exposure to what amount of CO2, how many tons of CO2 do I own of the emissions that the companies that I own emit.
Okay.
So that would be my investment carbon footprint, and I can contrast that against a benchmark. And so you understand whether you are above or below the benchmark. The benchmark could also be your own portfolio 2 years ago, whether you're more carbon intense or less carbon intense than previously. That's the very first step that an investor takes, and it's typically a very good one to start with. It has some limitations, but it quantifies the topic of climate change in something that investors typically can process very well, which is numbers, tons of CO2. CO2 in many geographies has a price, so you can associate a price with that. So you can convert tons of CO2 into, for example, basis points. So you can say, the theoretical cost of the greenhouse gas emissions that you as an investor are responsible for is equivalent to half a basis point. And that is then translated into a language that is understood across an organization. And from then on, we analyze what I mentioned before, the transition risks. So these can be risks that are very sector specific. So we would tell you what of the companies you are invested in, and let's say in the oil and gas, in the energy sector, have exposure to tar sands or to Arctic drilling or other practices that in a transitioning world might face the risk of being reduced by the regulator or blocked by the regulator. We look at physical risk. So what is the physical risk exposure, acute and long-term, of a company in your portfolio? And then we look at what we would call scenario analysis. You might be aware that the world committed in the Paris Agreement to limit global climate change to well below 2 degrees. Keep in mind, we are currently geared towards 6 degrees of warming. So if you really stick to this 2-degree target, which every single country in the world signed and most countries ratified, that means that a lot of industries have to change. So we look at what companies in your portfolio are or can be 2-degree aligned in the future. Will still have a business model in such a world that we committed to transition to.
And then
there's much more to that. Yeah, sorry.
It's interesting. Yeah, I was going to ask through this work that you have been doing, how are investment asset classes being affected by climate change overall? Like, what have you seen?
I mean, I would say I would differentiate between liquid and non-liquid asset classes. I think this is in our world the most important distinction. Why? Because when it comes to physical risks, so the physical effects of climate change, the increase of floods and droughts and storms and so on, these risks are 10, 15, 20 years out, and they increase over time. But in a liquid asset class, you of course can trade out of them, right? So I would say physical risks, or let's say liquid asset classes, are very much focused on the transition risk. So with your equity portfolio, you are concerned about a government committing to a carbon price tomorrow.
Yes.
Because at that moment you might hold a company that is a large emitter, and the carbon price might hit the share price. You're not so concerned from a pure risk perspective about the physical effect of climate change in 10 years or 15 years, because by that time you might not own that company any longer. When you think about non-liquid asset classes, namely real estate, private equity, it's an entirely different ballgame. We see that today in this non-liquid asset classes, physical risks are being taken into consideration in the moment of onboarding that asset, in the moment of the investment. Okay. So in other words, if you build a hotel on the shores of Florida and you realize that the hurricanes are increasing in magnitude and in their strength and in the number, that matters to you much more how the world will be looking in 15 or 20 years and how climate change might impact these storms. So this is much more the view that also an insurance company would take on selling you insurance for that hotel.
And has the impact to the bottom line been an impact on profitability, positive or negative? Like what classes of firms could be affected by this in terms of profitability, positive or negative?
It's a very interesting point. There are a lot of studies being done on that right now, and results are out. So the question on whether the risk of climate change is priced into company valuation already today. And you do find a lot of studies that support this view, that basically companies that have the risks and opportunities of climate change better under control than others. If you create a basket of them and run them against an index, or companies that are less carbon intense, there are studies, quite a few studies out there that show that these companies outperform their peers. So that is also, by the way, a reason for an increasing amount of low carbon investment strategies that are currently being created, have been created over the past few years, where asset managers put together portfolios with such firms, and by means of backtesting, especially in the index space, show that an outperformance, kind of a carbon alpha or so, is possible.
Very interesting. And do you know of any indexes like passive index or smart beta index that currently exist, which focus on firms with a view to focus on climate change?
Yeah, I mean, I would almost turn it around. There is hardly any major index firm out there that doesn't have some sort of a climate-adjusted index family. I would say they are, at very different levels when it comes to sophistication. The most basic ones are typically indices that either exclude fossil fuel companies. So, they have what we would refer to as a divestment approach. So they would resemble a reference universe, but without the oil, coal, and gas companies, or they, either kick out or reduce exposure to companies that have a larger carbon footprint than their peers, so that they basically emit more emissions than their peers for the same output, i.e. they are less carbon efficient. This is kind of the first generation of indices, and there you find, in the developed world, definitely for every, or almost every index, a low carbon version. What I'm excited about are the kind of 2-nil or 3-nil indices that are more sophisticated and try to invest in companies, for example, only companies that have a 2-degree target committed to. So companies that already today say, we are committing to transition to be in alignment with the climate, which are around 400 companies out there from across all sectors. Or, you invest only in companies that do have a climate strategy and don't invest in those that don't or so.
Interesting. And how do institutional investors invest in climate change today, and how can retail investors look to investing in climate change?
Yeah, so I would say that institutional investors, depending on what you look at, but the large asset owners in Europe have all started to look into the topic of climate change, and the flagship asset owners in the US have as well. Same goes for Australia, and now since about 1 year, Japan as well. And the way that they approach this is that they first want to figure out where they stand. So they do a kind of a status quo assessment of what is my exposure to climate change today. And then they typically set themselves some sort of either a pathway, so they have a climate strategy, and now more often than not, this strategy might include targets. And that target could be, we commit to bring down our carbon intensity of our portfolio by 20% by 2020, or we want to bring up the companies that have a climate strategy in our portfolio. And what plays a big role there is, of course, another area that we're involved in with ISS, which is the topic of proxy voting, engagement in proxy voting. In North America, the number of shareholder resolutions on the topic of climate change were at an all-time high last year with 89 shareholder resolutions addressing the topic of climate change that were brought forward. this year to date, so now it's April 2018, we are already at the same amount. So we expect that there will be this number will be much higher this year. And this is, these are shareholder resolutions that ask companies to give themselves, to disclose their greenhouse gas emissions, or to give themselves a 2-degree target, or things like that. And these shareholder resolutions are increasingly backed by institutional investors, who often drive those in some sort of a collective engagement initiative. So you have this backed by the large pension plans in New York and California and so on as well. And it's these are the ways that institutional investors are getting involved, and then they look for products that helps them to manage their greenhouse gas emissions or their climate impact in general, to manage that down. So that's also a reason why we see increasingly investment products popping up in that space. Retail investors, it's a bit of a different story, but there are now online platforms available for retail investors where they can basically go online, type in the name of a fund that is available for retail investing, and basically see what the climate impact is. The one that we have been building on behalf of the European Union is called Climetrics. So the source is climetrics-rating.org. We can probably put that in the description of the webinar. But that is a platform where you can look virtually every of the 5,000 largest retail funds that are registered for sale. So that includes some US funds as well, and check them for their climate impact. It's free of charge. You just go on there, you type in the name of the fund, and it tells you whether the fund has 1 to 5 leaves. So we translated these rather sophisticated data points into something that is easier to digest, which is kind of a leaf system. So 5 leaves is obviously better than 4, and so on. So that is something that retail investors can do to invest there, and they can of course walk into their bank or talk to their advisors and ask for climate adjusted investment products. There's an increasing amount available.
Wow, that's interesting. And finally, where can investors find more information on climate change investing, and also learn more about your work?
I mean, we produce quite a bit of research that I personally, as you can probably tell, find quite exciting, and that you find on our website, issgovernance.com,
yes,
where you then can look for the climate solutions bit, or you can mail us or reach out to us. Other resources that I find useful are think tanks. There are 2 in particular that deal with investment in climate change that are worth mentioning. One is called the Carbon Tracker Initiative, and the other one is called the 2-Degree Investment Initiative. Carbon Tracker and 2-Degree Investment Initiative, great resources especially for methodology junkies like myself. Great way to read up on different approaches to the topic of investments in climate change.
Great insight, Max, on the whole industry here and investing in climate change. Thank you very much for coming on to the program show.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.